Everyone is betting on the same EV trade. Buy the battery makers, buy the lithium miners, follow the gigafactories. But here is a question nobody is really asking. Who makes the chemistry inside the battery? Not the cell, not the pack, the actual molecules that make the thing work. Because right now, 3 Indian companies sit inside that chemistry, quietly, without much fanfare. And the world is about to start caring a lot more where those molecules come from. Before you get too excited, here is the honest version of the story. These 3 companies, Gujarat Fluorochemicals, SRF and Navin Fluorine, they do not make most of their money from EV batteries today. Not even close. Right now, their biggest business is refrigerant gases. The stuff that goes into your air conditioner, that is what pays the bills. So why are we talking about them in the context of batteries? Because the same chemistry that makes the refrigerant gas also makes the materials inside the lithium-ion battery. And that overlap is everything. To understand why, you need to understand one element: fluorine. Fluorine forms the strongest single bond in organic chemistry. That means materials built on fluorine are extraordinarily stable. They resist heat, they resist corrosion. They do not break down easily. That is exactly what you want in a refrigerant gas that must not degrade inside a compressor. And it is exactly what you want in a battery that must survive thousands of charge cycles at high voltage. 2 specific materials make this concrete. Lithium PF6, that is lithium hexafluorophosphate, is the dominant electrolyte salt in almost every lithium-ion battery on the planet. It contains more than 75% fluorine by weight. PVDF, that is polyvinylidene fluoride, is the material that holds the cathode together, the binder that keeps the whole thing from falling apart. Also fluorine-based. No fluorine chemistry, no lithium PF6. No lithium PF6, no working battery. It is that direct. But here is where it gets interesting. All of this, the refrigerants, the battery salts, the fluoropolymers, every single product in this chain flows through one molecule. You can make hydrofluoric acid, that is HF, by reacting acid-grade fluorspar with sulfuric acid. And from HF, you build everything downstream. Refrigerant gases, PVDF, lithium PF6, the lot. Now, HF is not a molecule you want to handle carelessly. It is lethally dangerous. Exposure to even small quantities can be fatal, which means you cannot just set up an HF plant overnight. You need regulatory clearances, safety infrastructures, years of operational experience, and specialized engineering. This is what creates the most: the companies that already own captive HF capacity, and ideally, the fluorspar mine upstream of it, sit at a choke point that new entrants cannot simply buy their way into. Gujarat Fluorochemicals goes furthest here. It owns a fluorspar mine in Morocco. It makes its own HF and it converts that HF all the way down to battery-grade lithium PF6 and PVDF binder. That is the full stack. Here is why this all matters right now in 2025 and 2026 specifically. 2 enormous global transits are hitting the same chemistry stack at the same moment. The first is climate regulation. Under the Kigali Amendment, the world is phasing out older, high-warming refrigerant gases and replacing them with next-generation HFO refrigerants. The catch? HFO synthesis is more complex than the older gases, and it requires significantly more HF per ton of finished product. So the refrigerant transition is actually increasing demand for the very feedstock that sits at the top of this chain. The second transition is batteries. EV adoption is pulling demand for lithium PF6 and PVDF upward at a pace. The global lithium PF6 market sits around $2.7 billion today and could reach $7 to $11 billion by early 2030s, depending on how fast cell manufacturing scales. 2 demand curves. 1 HF bottleneck. That is the setup. Now add the China problem. China produces over 60,000 metric tons of lithium PF6 annually, accounting for more than 70% of global supply. For PVDF, the concentration is similar. Every battery maker outside China that wants to build a non-Chinese supply chain has to find an alternative. And right now, credible alternatives are scarce. That is the opening. Gujarat Fluorochemicals, that is GFL, is the only one of 3 that has moved battery materials from a plan into actual commercial production. Its battery subsidiary, GFCL EV, has started supplying lithium PF6 commercially as of December 2025, with repeat orders already coming in by Q4 FY26. PVDF binder is due to commercialize in the first half of FY27. The funding story matters too. The IFC, which is the private investment arm of the World Bank, put in $50 million. A second global investor added $80 million. That is $130 million of external capital committed to a single battery materials facility in India. The IFC called it their first battery material investment outside China. GFL's FY26 consolidated revenue was roughly 4,996 crore rupees, with EBITDA at a 26% margin. The refrigerant segment had a soft year due to US tariffs and seasonal factors, but fluoropolymers grew 14%, driven by semiconductor demand. That battery vertical is now producing, not just promising. SRF is the largest of the three. FY26 revenue of 15,786 crore rupees. PAT up nearly 47% to 1,835 crore. The Fluorochemicals and Specialty Chemicals division is doing the heavy lifting, and the packaging films business remains the weak spot. SRF battery story is more indirect. It is building a 2,300 crore rupee project that includes a new 30,000 ton per annum HF plant and a 20,000 ton HFO facility. Completion is targeted for February 2028. The thesis here is about owning the right infrastructure for the transition, not about selling battery salts today. Think of SRF as the company that will benefit first from the refrigerant transition, and then, as HF titans globally, will have the platform to go further downstream if it chooses. Navin had the cleanest FY26 of the three. Revenue up 41% to 3,314 crore. Operating EBITDA margin at 32.6%, the highest of the trio. PAT up 130%. Its strength is specialty and CDMO, which means it makes complex, high-margin, fluorinated molecules under long-term contracts, often for pharma and agrochemical clients globally. It just signed a $410 million multi-year contract. That is not a small number for a company of this size. Navin also just commissioned a new 40,000 ton per annum anhydrous HF plant at the Dahej. Its management is explicit. They expect a global HF shortage in the next 2 to 3 years, and they want to be self-sufficient before it arrives. Battery materials for Navin are genuine optionality, not a current revenue line. Own it for the best fluorine chemistry business in India today and treat any battery contribution as upside you are not paying for. So what is actually being underwritten here? It is not that batteries suddenly transform these companies next quarter. It is not that India replaces China in fluorine chemistry by 2027. The real bet is simpler and more durable. These are world-class fluorine businesses, already profitable, already growing, already integrated into a choke point chemistry. The refrigerant transition is paying their bills today. The HF shortage, if materializes, raises their pricing power. And if India's cell manufacturing actually reaches scale, they are already qualified to supply it. The signal to watch is not EV sales numbers. It is GFL's Lithium PF6 plant utilization crossing from qualification orders to committed volume offtake. It is whether Reliance, Tata Agratas and Exide actually start making cells, not just assembling packs. And it is whether the proposed government scheme for cell component materials, which currently exists only on paper, gets enacted. When those three things start moving together, the structural optionality transforms into real commercial revenue. Until then, these companies remain deeply anchored in their traditional profitable chemical markets, meaning they don't need the EV transition to survive, but they are uniquely positioned if it arrives. So here is the question we want to leave you with. GFL, the integrator, SRF, the scale player, Navin, the compounder. Which one do you think is best positioned for the decade ahead? Drop your take in the comments. We read every one. The biggest opportunities are often hiding a few layers beneath the obvious story. The next time you look at the EV space, don't just study battery makers. Study the chemistry behind them too. If you enjoy research like this, subscribe to Invest with Share.Market.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.